What exactly is the market share that everyone is talking about? Market share can be defined as a company's share of total sales in the market in which it operates. The market now often refers to a company's target consumer base, such as the worldwide transportation market or the whole FMCG market. However, when determining and comparing a business's market share, the definition of market varies. It could be an industry with comparable players, a regional market, a product sector, a product category, or a group of competitors. To understand the concept of market share even better, let's take an example. Let's assume you're the only customer on this planet. And say, you plan to travel by train. You can book your tickets and travel only by Indian Railways. This implies that Indian Railways has 100% market share in the railway industry of the country. In contrast, let's say you buy 10 chocolates. If you buy 6 chocolates of brand A and 4 numbers of B Choco bars, that means A holds 60% and B holds 40% of the total market share in the chocolate industry, respectively. This bifurcation gives a clear picture as to the position of the business in the market, its contribution towards the growth of the said market. It helps businesses build better strategies for their growth. Also, for stock trading, it helps potential investors assess the company and decide if it is worth investing into. How to calculate market share? Calculating market share involves a straightforward formula. Here's how you can do it. 1. Determine the total market size. Start by figuring out the total sales revenue, units sold, or another relevant metric for the entire market. This could be for a specific industry, product category, or geographic area. 2. Calculate your company's sales. Next, determine company's sales within that same market. This could be your total revenue, units sold, or another applicable metric. 3. Apply the market share formula. Finally, use the following formula to calculate your company's market share. Market share % equals total market size divided by company's sales multiplied by 100. Interpret the result. Once you've calculated the percentage, you'll have company's market share. This figure represents the proportion of the total market that your company controls. Let's break down an example. Suppose the total sales in a particular market are rupees 1 million. Your company's sales within that market are rupees 200,000. Using the formula, market share % sad smiley 200,000 divided by 1 million multiplied by 100 is equal to 20%. So, your company's market share in this example would be 20%. Importance of market share. Firstly, market share is a key indicator of a company's competitiveness. A higher market share typically indicates that a company is doing something right, whether it's offering superior products, better pricing, or more effective marketing strategies. Secondly, market share influences a company's bargaining power. Think about it, when a company dominates the market, suppliers and distributors are more likely to negotiate favorable terms with them, giving them a competitive edge. Thirdly, market share is closely tied to profitability. Companies with larger market shares often enjoy economies of scale, lower production costs, and higher profit margins, which can lead to sustained financial success. Having a larger market share can offer several advantages for a company. 1. Increased revenue. Companies with larger market shares often have higher sales volumes, leading to increased revenue. This revenue can be reinvested into the business for further growth and development. 2. Economies of scale. With higher sales volumes, companies can achieve economies of scale, reducing the average cost per unit of production. This can lead to higher profit margins and a competitive advantage over smaller competitors. 3. Brand recognition and trust. Companies with a larger market share often enjoy greater brand recognition and trust among consumers. This can result in increased customer loyalty and willingness to purchase from the brand, even at premium prices. 4. Greater bargaining power. Companies with a larger market share often have more leverage in negotiations with suppliers, distributors, and other partners. They may be able to negotiate better terms, lower prices, or exclusive agreements, further enhancing their competitive position. 5. Ability to influence market trends. Companies with a significant market share have the power to influence market trends and consumer preferences. They can introduce new products or innovations that shape the direction of the industry, solidifying their position as market leaders. 6. Barrier to entry for competitors. A large market share can act as a barrier to entry for potential competitors. It can be challenging for new entrants to capture market share from established players, especially if they have strong brand loyalty and economies of scale. 7. Investor confidence. A larger market share often translates to higher profitability and stability, which can attract investors and shareholders. This can provide access to additional capital for expansion and growth initiatives. So, how can companies improve their market share? Well, here are a few strategies to consider. 1. Invest in product development and innovation to stay ahead of competitors. 2. Enhance customer experience to build brand loyalty and attract new customers. 3. Implement targeted marketing campaigns to reach specific market segments. 4. Form strategic partnerships or acquisitions to expand market reach. In conclusion, market share is not just a metric, it's a critical indicator of a company's competitive position and long-term viability in the market. By understanding and actively managing their market share, companies can better navigate industry challenges and drive sustainable growth. And that wraps up our discussion on market share. If you found this video helpful, don't forget to like, share, and subscribe for more insights on business and economics.
Thank you for joining us today. If you found this video informative, please give it a thumbs up, and don't forget to subscribe for more financial insights. And, as always, if you have any questions or topics you'd like us to cover in future videos, leave them in the comments section below. Until next time, happy investing.